This video is related to share market. The topics covered in this video are important things to think about before buying stock, definition of liquidity in relation to the stock market, and how do we determine whether a specific stock has high or low liquidity. Before buying a share in a company, it's important to conduct thorough research and consider several factors to make an informed investment decision. Let us discuss some key factors to consider. Analyze the company's financial statements, including its balance sheet, income statement, and cash flow statement. Look for trends in revenue growth, profitability, debt levels, and cash flow stability. Research the industry in which the company operates. Understand the current market trends, growth prospects, and competitive landscape. Industry performance can significantly impact a company's success. Evaluate the company's management team and leadership. Look for experienced and capable executives who have a track record of effective decision making and strategic planning. Consider the company's competitive advantage or unique selling proposition. What sets the company apart from its competitors? A strong competitive advantage can lead to sustained growth. Earnings and dividends. Examine the company's earnings history and dividend track record. Consistent earnings growth and dividends can be positive signs of a stable and well-managed company. Assess the company's valuation relative to its peer and industry benchmarks. Common valuation metrics include price to earnings, PE ratio, price to book, PB ratio, and dividend yield. Understand your own risk tolerance and investment goals. Different stocks carry different level of risks. Consider whether you are looking for growth, income, or a balanced approach. Be aware of broader economic conditions such as interest rates, inflation, and geopolitical events. Research the regulatory environment in which the company operates. Changes in regulations can affect the company's operations and profitability. Stay informed about recent news, announcements, and events related to the company. Positive or negative news can influence stock prices. Consider the company's long-term growth potential. Are there new products, markets, or innovations that could drive future growth? Some investors use technical analysis to study historical price and volume patterns to predict future price movements. However, this approach may not be suitable for all investors. Think about how the potential investment fits into your overall portfolio. Diversification can help manage risks by spreading investments across different assets and sectors. Consider the liquidity of the stock. Highly liquid stocks are easier to buy and sell without significant price fluctuations. Determine whether you are looking for a short-term trade or a long-term investment. Your strategy may influence the factors you give priority. Investing in stocks involves risks, and there are no guarantees of returns. It's advisable to do your own research, possibly consult with financial advisors, and make decisions based on your individual financial situation and investment goals. Now, I will discuss the meaning of liquidity in the context of share market. In the stock market, liquidity refers to how quickly and easily a particular stock or security can be bought or sold without significantly impacting its price. A stock can be considered highly liquid if there are enough buyers and sellers in the market to allow for seamless transactions with minimum price fluctuations. A stock with low liquidity, on the other hand, may have fewer buyers and sellers, making it more difficult to execute trades with impacting its price. Few important factors to understand regarding stock market liquidities are: the bid price is the highest amount a buyer is ready to pay for a stock, whereas the ask price is the lowest price a seller is willing to take. The bid-ask spread is the difference between these two prices. This spread is frequently narrow in highly liquid stocks, indicating that there is little difference between what buyers are ready to pay and what sellers are willing to accept. The number of shares of a stock bought and sold in a given time period, such as a day or a week, is referred to as trading volume. Higher trading volume often indicates greater liquidity because more shares are traded. In stocks with low liquidity, even a small buy or sell order can cause a substantial price change because there aren't as many buyers or sellers to absorb the transactions. This is known as price impact. A market order is an instruction to purchase or sell a stock at the current market price. Market orders are more likely to be executed at or near the expected price in highly liquid stocks. In low liquidity stocks, however, market orders may result in execution at a significantly reduced price. Limit orders, which set a specific price at which you are willing to purchase or sell, can help you manage price effect in low liquidity situations. High liquidity is sometimes regarded as an indication of a strong, actively traded stock. It has the potential to attract more investors and establish trust in the market's ability to absorb massive deals without triggering significant price movement. Because of a limited number of market participants, low liquidity stocks may display more volatility. This might provide chances for traders, yet also offering risks. Highly liquid stocks are often easier to trade, but because there are more players, they may also be more competitively priced. Low liquidity stocks are riskier owing to potential price gaps, but they may be give possibilities for individuals ready to do thorough research and handle their trades wisely. The key question is this: how can we determine whether a particular stock has a low or high liquidity? Here is the solution. The average daily trade volume is a key indicator of liquidity. This indicator indicates how many shares of stock are regularly purchased and sold each day. Stocks with larger average daily trading volumes are often thought to be more liquid. This information can be found on financial news websites, stock market platforms, or financial data suppliers. A narrow bid-ask spread indicates higher liquidity because there are smaller difference between buying and selling prices. Generally, larger companies with higher market capitalizations tend to have higher liquidity as they attract more investor interest and participation. Stocks with consistently high trading volume are more likely to be liquid. In contrast, stocks with irregular or sporadic trading volumes might have lower liquidity. Stocks with a higher number of market makers usually have a higher liquidity, as these market makers help ensure there are always buyers and sellers in the market. In highly liquid stocks, larger trades should have minimal impact on the stock price. In low liquidity stocks, even a moderate trade can cause noticeable price fluctuations. Low liquidity stocks may show price gaps or spikes due to fewer market participants. Compare the stock's liquidity metrics to those of similar companies in the same industry. This can give you a relative sense of its liquidity position. News can impact trading activity and liquidity. Stocks with major new trends to experience higher trading volumes. Liquidity may change over time depending on market conditions, corporate performance, and investor opinion. Before making investment decisions, it is essential to obtain a variety of information from reliable sources in order to make an informed assessment of a stock's liquidity. Thanks.